Time now to have an update on a regular series of interviews that we've been undertaking with AIM portfolio management specialist Chris Boxall from Fundamental Asset Management on high yield AIM stocks. Chris, welcome.
Hello, hello.
How's the year started? Well,
it started really well. I mean, we've had a lot of positive moves, a couple of big sort of sellers, but you know, it's been a really good start to the year with the usual mix. We've got 14 stocks here. The average market cap's about 100 million, ranging from about 40 up to about 360. We tried to ensure there was some liquidity in them, so you could actually buy the things rather than just comment on stocks that nobody could acquire. And it's been interesting. Look, these are not. This is a high yield focus, so these aren't the most exciting of growth stocks. Okay, well let's take a look at them. As I said, we've been talking to you over the last couple of years about these. Let's bring up the list that we've got for the AIM high yield portfolio. Now, you say there's a couple of new stocks here. I know this is always what happens with AIM-listed companies. They get taken over. Yeah,
some lose, of course, the will to live in some cases. I know in another interview we've covered patisserie Valerie, which of course went to the wall in spectacular circumstances. But here we have this portfolio that we've been talking about the last couple of years, but there have been some changes. Just pull out a couple that you want to talk about.
Yeah, well, I mean, first up, let's take the one on the top there, K3 Capital Group. And we did warn about this before, really, what could happen. This was our one big outperformer, doing fabulously well. The yield, as a result, the share price was flying, but then yield. But then it got hit by some turbulent markets, really. And it's really Brexit-induced, this. A lot of delays. They're a company sales specialist. So they're selling, acting as agents to sell and structuring the deals around the sales of small businesses. A real, in my opinion, a fair weather stock. I mean, the economy's great, everybody's very dynamic, everybody's happy, going to be lots of activity in the business sales process. Now, you've had a bit of a hiccup, you've got a bit of a hurdle there with Brexit, people are umming and ahhing, a few delays, so they're now talking about pipeline, but delays in actual contracts coming through the due diligence process and getting to finalisation. And as a result, you've seen the share price fall off materially. So this one's really cyclical, and we did say, I can't repeat this more than I have done really, that it is going to be prone to cyclicality, and those that haven't got a huge stake could perhaps play this. You know, get out when times are good, or sit patiently if they want to and soak up the dividends.
So you're saying if you've got cash, this might be a good opportunity?
Yeah, I think so.
Subject to Brexit getting resolved.
Yeah, the longer the delay, the greater the uncertainty. Everything's stretched out, and you're going to be treading water for longer on this stock. But look, it's very low capital intensive. It's just people, a lot of commission driven as well. So base costs are quite low. Generates loads of cash, enough to pay out the dividend, and it's got heaps of cash in the bank. So it could be an interesting one. But how big can this company get to really? It's circa 60-odd million. Is this a 100 million plus business? I'm not so sure. Great management, they own a lot of the shares. Very, very slick marketing sales approach. There's a lot to like about it, but a lot to be wary as well, in our opinion.
Okay, going back to the list, one of the stocks I know you want to talk about today is Manx. Now, Manx no longer appears on this list. I bring up the list because I want to show that the portfolio no longer has this on there because it's been sold.
Yeah, it has. So it's been acquired. Well, it's going through at the moment. It doesn't look as though there are going to be many obstacles to it. Manx Telecom, virtual monopoly position in the Isle of Man. This is the business we were somewhat unkind about, or the management team I was somewhat unkind about idiots running businesses, to paraphrase Warren Buffett. And I still maintain my position that really anybody could run this business. I don't think they made a terrific fist of it. It listed at what did we say, about 142. It's paid out some decent dividends. It's done very little with its listing. Heaven knows why this business comes with inheritance tax relief on it, but it does. It's a real quirk of the system. Isle of Man business, doesn't pay corporation tax, largely employs Manx residents. It's no good to man or beast of the UK tax system, as far as I'm aware, yet UK shareholders in this business will benefit from an inheritance tax break. It's incurred huge transformation costs as well. So again, may sound unfair, but good riddance. I prefer to have more exciting, more worthy business on the market.
Well, let's take a look at the stock that you've replaced Manx with. What are you going for?
We're going for Warpaint. Warpaint's a cosmetics business. It hasn't been on the market that long, and as you'll be able to see from the chart, it's had a bit of a roller coaster experience.
It's yielding 6% at the moment, so that looks good.
Yeah, indeed. It arrived not long ago, and you can see the share price flew on the basis of good results. It had been growing at sort of 16% compound over the last few years. And again, it's a business that 50% of its sales of cosmetics are into the UK retail space, and it got really whacked around Christmas time. It also mistimed an acquisition. It raised about £21 million to support the acquisition of another cosmetics business which specialised in the gifting area, and that was obviously even more exposed around the UK, the poor UK retail space. It is endeavouring to grow meaningfully overseas. The founders, the co-chief executives, still own 50%, so they've got a lot tied up, albeit they did take a lot off the table on IPO. It outsources everything, so it's high margins, low capital requirements, nice. It ticks a lot of boxes, but the cosmetics sector, you may need some specialist knowledge to really feel comfortable. Seems to me the likes of L'Oreal are doing fabulously at the high end, growing tremendously in China and emerging markets. Warpaint is trying to grow in the US. It has exposure to China, but this is their products are lower cost. We'll see how it gets on. Again, decent cash generator, net cash. Hopefully things could improve, and we could see that share price return quite sharply. But a real hiccup. In the meantime, we get a nice dividend, about circa 6% yield.
Yeah. Property Franchise Group is another one we want to talk about. And I know if you can bring up the list again. This one has a yield of 5.4%, I think, but it's seen a 40% year-to-date improvement.
Now, I think this is contrary to, unlike Manx, I think it's a very well-run business. It's in the area of franchise lettings predominantly, and it's very, very similar to Belvoir Beaver lettings, which we've also got. So we've got two businesses with very similar dynamics. The difference between property franchise to Belvoir is that property franchise has a very nifty little hybrid online estate agency called YouMove, which seems to be doing quite well. It's actually profitable. Unlike Purple Bricks, it's actually profitable, and it's sort of hidden in the bowels of property franchise. Results recently from property franchise were fabulous, up 11%, revenues up 11%, earnings similarly positive if you strip out an exceptional gain they made the previous year. Net cash, highly cash generative, low capital requirements. Again, it ticks a lot of boxes. Management own a big chunk of this business, which is again reassuring. Unlike Belvoir, no debt. Belvoir has debt as well. A great performer in the period. We like it, quite like it. Small though, only 40 million market cap, so liquidity is a bit tighter.
And there's also a new position, I understand, in
yeah, interestingly, a German fund group has acquired a 10% stake in Property Franchise Group. We've mentioned previously that UK PLC is sort of up for sale if prices get too low, currencies underwater a little bit, and good value businesses are being snapped up. And it's not the first one. The previous company we spoke about, Warpaint, I think a Danish fund management group has also acquired a 5% stake in that one. Two interesting moves in two relatively little-known businesses, we think.
I know as well you want to talk about Redder, the accidental management solutions company for motorists.
Yeah.
What's on the horizon there? What's interesting you in that stock?
Well, Redder's always been a yield play. It's always offered a decent dividend, and you can imagine it's not the highest growth arena, that accident management in the UK, and it did very well last year from the poor weather. Lots of accidents to manage, lots of legal services required, and this year it announced things weren't quite as good as the prior year. It was keeping its dividend flat. Again, that disappointed. Then soon after that we had news that it had lost a contract, quite a meaningful contract that represented what it was a circa 7% contributor, I think, to the bottom line. So meaningful contract, a lot more to the top line. So clearly it was a lower margin contract with a major insurance group that had been a customer for a long time, and that really whacked the share price. Since then, the directors have acquired a lot of shares, 200,000 shares or more at prices from 80 odd p up to over £1. They've reassured. We've spoken to them. We've looked at the space a little bit more, the marketplace, and it could be a buying opportunity in there. And you do get this circa 10% yield. Very contrary to what people may think of this. There's very little debt. This was the former help hire, which was heavily indebted. There's very little real debt in this business. Most of the debt is actually finance leasing relative to the vehicles, the fleets, the cars, the vehicles they've got. So there isn't actually any bank debt. So don't be put off if you look at the net indebtedness. It's all linked to their fleet of vehicles. But it could be an interesting recovery play.
Of course, cash flow is all very important to the high yield companies, isn't it? Because
Absolutely.
It provides dividends.
And people, many investors or analysts or researchers often miss out on it. They look at the cover of earnings for dividends, and often that's not reflective of what's really going on. You've got to look at cash flow. The business's ability to fund dividends from effectively its free cash flow. And NAHL is an interesting case in point. This business is effectively funding its dividends out of debt. It may like to present things differently, but it's going through somewhat of a transformation. It's having to invest it in its own legal cases, a bit like a litigation funder. It's having to put its own capital to work. And as a result of it, however, it's still maintained a decent dividend. So with all its cash going to support the funding of claims, it hasn't got enough free cash to support the dividend. So the debt's been going up. Thankfully, it's paying very little for its debt, in a mitigating factor.
Are you happy about that? Because I mean, that's one of the things I'd have thought that you, as a fund manager, would frown upon with a small cap company.
I'm not particularly happy. No, I'm not particularly happy about it. It's a questionable play. You can see if this business does, so it's a play really. Yes, you're getting some dividends, but that's not that comforting. This is actually a play less on the yield, more on the recovery potential of the business. Should its transformation work out? Should it really deliver on what it's trying to do? And it seems to be going in the right direction. This change of business model seems to be going in the right direction.
When we have you back in another quarter or so, we'll ask about this to find out.
That's the fun of that. Really exactly. The fun of this high yield little lot we've got here.
Okay, Chris, thanks so much indeed for updating us on your high yield AIM portfolio. That was AIM portfolio management specialist Chris Boxall from Fundamental Asset Management.